We are back in your life, and today we're looking at the smart data that property investors are following. Adam Farrell, Lighthouse Property Director, joining me today. Adam, we might say that the property market's had a bit of a rough run recently. I see a lot of headline noise about, look, it's down, it's out, it's never coming back. You're an idiot if you buy a property. Tell them why they're wrong.
Yeah, I mean, look, I don't think it's a recent thing. The property market's had a pretty tough run for the last couple of years.
Yeah.
And I think with the mixture of global headlines and uncertainty combined with New Zealand's less than adequate or ideal position, it's kind of a perfect storm for people to be pretty scared and buy into the headlines a bit more than usual with the typical fear-mongering that we know the news headlines to be.
Yeah, I was reading something this morning and it was basically, it was on like Stuff or something. It was like, why the property market's never coming back. And I was like, wow,
I would suspect we could probably do a bit of study on that. And, you know, if you go back any 10-year period, there's each point in the cycle, the bottom point.
They'll be like, it's never coming back. Yeah. This is why it's dead. Yeah.
I think I actually saw a LinkedIn article about that. Someone posted like from back in the 80s.
Yeah.
And they're like, why the whole market's going to crash permanently and all this sort of stuff.
Yeah. Man, LinkedIn, not my ideal stomping ground. Let's start looking at these key indicators then. So the first one, we've got construction activity is starting to pick up again. So, you know, almost 40,000 new homes were consented across New Zealand from May 25 to May 26. Now, we know that consents aren't buildings, but surely that's a good sign.
Yeah, I mean, building consents, I think when we were putting this podcast notes together, I was thinking a little more in detail about the relevance of it and what it means for property. I think it is somewhat of a leading indicator of confidence. And funnily enough, I don't have the data on me, but we looked at trends previously, historically, of property prices and building consents, and the trends tend to match up pretty well.
Yeah.
And if you take a step back and think about that, I think there's two reasons for that. One, it's either indicated there's more developers getting in the market, building more dwellings, or the building consents could be for residential homes, in which case people are more willing to spend money on either upgrades or new homes. Both of those are good leading indicators because developers are often in the market where selling off the plans, they're trying to time when they think buyer confidence is going to be stronger.
Yeah.
A lot of them have been sitting on the sidelines for the last while. So now that the pipelines are moving a bit faster, it's probably an indication that they have more confidence that in 12 months' time, there'll be a lot more buyer activity.
Yeah, because they're all forward-looking, right? I think that's the thing. So, and this is really obvious with property developers when the market's on the way down and everyone's like, oh, look at them get caught out. You know, they're not selling houses, got these margins. Like, well, yeah, they're trying to build $1 million asset a year in the future on today's pricing. So like, you know, they are definitely always trying to plan forward, buy land now, develop in the future, you know, to try and maintain some margin. But yeah, I see the new consents as a really good sign of activity, especially given where the market is at in terms of like the money market, the economy, confidence. You know, I see that, in terms of a leading indicator, I think this is a really positive sign.
You're the money man, Mike. What do you think that means for the wider economy?
Man, I wish I was the money man. I can get you money. I ain't got no money. I think it's a positive sign for the wider economy. My only thing is just consents aren't buildings, you know, and like sometimes we see a bit of a discrepancy between the two. So long as, but again, like in economics and money and markets, you're always looking at trends, right? You're looking forward and you're looking at trends. I think if it's trending up, that's a good thing. You know, even if it's just down to confidence, right? Like the confidence that people have that the market's going to be better in 12 months and they want to be selling houses in that market, I think that's a good thing.
Yeah.
And again, like, you know, there's a wider argument about like why is it just property that we're looking at and what are the other economic indicators? Fine, I get all that. But, you know, there's a money multiplier effect with money that's been spent on property. So if you build a house, you are employing a lot of people, right? If you think about how many people that employs from concept, design, selling, right through to like code of compliance, like the activity that generates in an economy. And yeah, we're not selling stuff overseas and that sort of stuff, but like it generates a ton of economic activity. So I think it's a great indicator.
Cool, awesome.
Point number 2, counterintuitively, we've got rising construction costs. Why would this be a good thing?
Yeah, well, truthfully, it's probably not the best thing for developers and builders. Less so builders, more so developers, purely because builders
get their margin regardless.
Builders,
pricing.
Yeah. Most builders will get their margin regardless. Developers, on the other hand, are selling a finished product. So it's based on the perceived value of that product. most buyers don't really factor in anything to do with the cost of delivery. And so if the cost of delivery or production has increased, but market perceived value hasn't changed, the margin is squashed. And so there's quite a lot of developers in the space at the moment that are just doing developments to keep the wheels turning. Purely just kind of holding on until the market rebounds, which, as some of the starters saying, they're hoping will happen over the next 12 months, as many of us are. The relevance, though, rising construction costs. So this can only last so long, right? Where there'll come a point where developers just can't keep providing property at their prices. They're not going to do it at a loss. Worst case scenario, they'll do it to maintain and keep the wheels turning. But realistically, they're in business to make money, and provide housing. So with construction costs increasing so heavily, the stat here, 30% increase in construction costs over the last 5 years, that is one of the key factors that underpins the property market. It's two things, in my opinion. One is supply and demand of land. That's the land piece. The other thing is the improvement value. And if the improvement value or cost to replace or build the home has increased, it's going to increase house prices at some point. So I actually find a lot of confidence in that. It actually beats inflation, standard inflation. Construction cost grows fast at the moment, especially with the global situations recently.
The conflict in the Middle East at the moment is pushing stuff up. Like we know that. I think we're always looking at things from different sides of the coin, right? For you, there are different players in the property market. There are people buying. And if you're buying a property and you're trying to buy a new build property, construction costs going up will lift the price of all houses. It won't just lift the price of new houses, because people will look at building a new house, go, that seems expensive, I'm going to buy an existing house. So construction costs increasing will actually lift the price of all the houses in the market. So if you're buying into the market, that might not be a good thing. Let's say you bought in 2021 and you have been praying, for 5 long years that you want your, you want a bit of equity back in the property. Construction costs increasing, general prices increasing, that might be a good thing for you. So there's always winners and losers with every scenario. Construction costs increasing, where I think this might bite people is if they're halfway through a project and it's a long project and maybe there's no fixed price in there, or there's a fixed price in there, but with every fixed price contract there comes, look, if the price of something doubles, I get to double my price, right? So I think that really needs to be looked at if you're entering into a long-term contract.
Yeah, that does make me think of a slight tangent, which is that with all the properties we do that are off the plans, they're fixed price. And so if you are under the perspective that the cost of delivery is going to increase over time, the price will increase therefore over time. A lot of our clients are securing properties right now. They're going to be completed in 12 months, but the pricing won't change regardless of the cost. And a lot of the smarter developers will have fixed price contracts for the suppliers anyway.
Well, they hedge it straight off the bat.
So they've mitigated the risk. But I would suspect that the more time goes on, the higher the cost of delivery is going to be. And if land price doesn't change, final sale price has to go up.
I think that's a really good point and we found this out during COVID when the cost of a lot of things blew out. And that was a really extreme example. But, not every developer operates the same. So some developers will have hedged their risk. Some developers who maybe aren't as slick might not have hedged that risk. So when you're looking at these types of projects, these long-term contracts, you've got to do your due diligence. And sometimes the cheapest option ain't the best option. You know what I mean? And it's really tricky to convey that to people, especially when you're spending $800,000, $750,000, $900,000. They're like, oh yeah, well, if I could get this one for 50 grand less, it's in the same location, looks roughly the same, surely this is a bargain. I'm like, it might be, or it might not be.
Yeah, and I think like any market, sufficient pressure will cancel out the low quality players. And a lot of that has happened. There's obviously been lots of liquidations and bankruptcies and developers have fallen over. So positives for the current buyers is actively in the market right now, as a lot of the crap has been eliminated. If it hasn't been, you kind of know pretty quickly what it is, because it's priced at fire sale prices. And in most cases, you can just look at these new builds and if they've put in effort and they actually take care in the properties they're building. But then the other opportunity that's created is because all of these other lower quality developers have slashed their prices and they're fire selling, the good developers, to even get the attention they require, they still have to bring their prices down quite a bit. So even in the last 12 months, as a developer I was on the phone with yesterday, last year they were selling a particular home type in Pakuranga for like $730K. They yesterday on the phone, unprompted, I wasn't asking them for a deal. They told me, hey, we'll take $650 for the same thing at the moment.
Ooh, nice. Yeah, it is interesting. I used to do a lot of finance for developers, like their customers, and I don't do I like so much of it these days. But I was doing some recently, just extenuating circumstances. And I was on the phone to this developer and they're like, mate, this guy, like, why can't he afford it? I'm like, he has like 50 grand of short-term debt. He has 20 grand deposit. Like this deal ain't happening. And they're like, we'll pay his debt off. And I was like, what? No, we will transfer him $50,000. I was like, you will transfer him, not a rebate. And they're like, no. I was like, cash in his pocket to pay off his debt. And they're like, yep. And I was like, if he buys one of your houses, they're like, yep. And I was like, and here's 20 grand for the deposit. You're going to like foot the rest. They're like, yep. And I was like, wow, way.
Yeah,
this is so sketchy.
So, I mean, alarm bells straight away.
And I know who the developer is, and like alarm bells were ringing anyway. But like, I was just like, man, this, it was such a warning sign. And this was like a rock bottom price development.
Sure. Yeah.
It was unreal. I literally couldn't believe the conversation I was having. I was like, how do you still have margin?
The positive to take from that is that there's a lot of deals to be had at the moment.
Yeah, just not those kind of ones. Yeah. All right, point number 3. What are the auction results telling us? So we're starting to see auction clearance rates slow down. So that is the percentage of properties that sell at auction versus the percentage that get passed in. So let's say I got 100 properties up for auction that day. If 60% clear, that means 60% are sold, 40% got passed in. That's starting to creep up.
Auction rates, in my opinion, are less of a leading indicator, more of an active indicator of what the market's actually feeling, where the confidence is at. Totally makes sense that there's a decline in auction clearance rates, and I've been paying close attention to a lot of them, and they are passing in left, right, and center. Even some of the ones where I watch list them just because the property appeals to me because it's beautiful, great location, all that sort of stuff. No bid, maybe a vendor bid, passed in, and then onto deadline sale the next day. No deadline sale offers accepted, price by negotiation, then to asking price, and then eventually to drop asking price. So anyway, moral of that story is that with auctions at the moment, one, they're an indicator that the market's not very confident, it's a great buying opportunity. But 2, if you pay really close attention to the right things, a lot of the vendors will feel the crunch when they realize their property is not as desired as they thought. And this happened to me, a month ago, as you know, where I watched a property get passed in at auction, wasn't really actively going to do anything about it, called the agent, long story short, made the deal happen, but it only happened because it got passed in at auction. And, a couple of years ago, that property would have sold every day of the week. Yeah,
100%. I think I was at an auction the other day for a customer, and it was funny. I was at the Barfoot auction in town, and I remember going there with customers at like peak. You couldn't get in the door. Like you literally had to register and stand outside and wait outside, and they call you in for the auction. And like even then the room was like packed. There were 5 properties selling, maybe 4 groups in the room. We were one of them, But the interesting thing was everyone was bidding on one property. Right. So like quality stock is still shifting. It's a lot of the other stuff out there where, but because it's a buyer's market, people can say like, there's something wrong with this one. It's something I don't like with this one. So then I can go to this other one, same price, same, still get a bargain. That for me, that's what I love, is that where most of my customers get a bargain is when they're going, someone else cares about this aspect of the property. I don't care.
Yeah.
So like it's not right for them, it's right for me, right? And just like taking on a little bit more risk.
Yeah, I think that's the big thing with why auctions are being passed in is because people aren't as willing to do the DD up front and make the investment. Yeah. Because they know it's a buyer's market, they know there's plenty around. So if they don't invest the time up front and money to make sure it's good to go before auction, they'll just do it afterwards, either on that property or a different property.
Naturally, New Zealand slows down during winter a bit, and then always slows down before an election. Election's a few months away. What's your prediction in between now and then? Do you think we keep trending down and then we kick back up in summer, or?
I think it's an interesting question at the moment. Typically speaking, it would be, my assumption would be, absolutely slow down quite a bit. I feel like there's a growing sentiment in the market that people are progressively becoming more aware that we're at the bottom, or more in agreement that we're at the bottom.
Yeah.
And so if that is the case, and everyone, or the majority of people generally believe that to be true, I don't suspect an election will actually have a huge influence over where it goes.
Yeah.
That's my feel at the moment.
Yeah. I think it kicks. I have been saying this for 3 years. But I think it kicks. This is our year. This is our year. Nah, I mean, like we have seen, especially like back into last year, most times we see a kick. Last year on our side, and we've got to remember, I'm talking about things from a lending perspective. And like, so I judge my volume of transactions on how busy we are on the lending side. It was definitely a kick at the end of last year on refinances and purchases. So we're hoping to see that again. And you know, El Nino summer, baby. I'm here for it.
Mike, beyond the auction results, there are a couple of other key data points that I think are relevant that I've been talking to clients about. One of them is GDP. You may or may not know, but the last quarter, GDP grew by 1%, which is not a huge amount, but it's the first quarter-on-quarter increase we've had since 2023.
Nice. And then for the listeners who don't know, what's GDP?
GDP stands for Gross Domestic Product, which is the value of goods and services produced within a country across a year. At the moment, we're looking at it quarter-on-quarter. As I said, not really a huge data point to get too caught up on, but just a little bit of reassuring data, considering that the economy on this basis is recovering a little bit.
It's the revs in the engine, right? It's like, how is the engine working? Are we producing goods and services? So, you know, we've been talking about property, like indicators specifically on property. This isn't a specific property indicator, but it really speaks to like, how is the country performing? What is the confidence like? Some of those kind of wider data points.
The next point I've been looking at, I don't know how to title this other than saying linear trend line. When you look at the long-term growth rate of Auckland, for example, say 6% per annum, that's on the conservative side, and you plot it over a long-term trend, like a straight line, and you look at what the market's done, we obviously had that massive spike through COVID, 2021 pricing, and it's basically fallen back to the trend line, which gives me a little bit more confidence that we're more or less in a stabilized position to recover from.
Yeah, we look at that long-term linear trend line as well, where it's like you had that cheap money spike, and then it fell off a cliff when money got expensive. And it's kind of just normalized back to its long-term average. So again, past performance, not an indicator of future performance. However, they are really important data points to look at when you're trying to make a decision about what you think your asset's going to do in the future.
Last two interesting points that I like to talk to clients about. One of them actually only found out just before this meeting, which is that Canterbury has surpassed its all-time high median sale price in the last couple of months.
I reckon it outstrips Auckland 2-1 in terms of growth over the next 10 years. I've been saying this. I keep saying this. I'm moving to Christchurch, baby. Well, it's like, so here's an interesting point. I was talking to my cousin Tyler on the weekend. She lives in Auckland, works in Auckland. She's got offered a job in Christchurch, same company, just shifting down there. And she was down there checking it out with her boyfriend for the weekend. And I was like, I was thinking about that. And I was like, I texted her, the most random text. I was like, hey, if your company had offered you the same position in Wellington, would you have taken it? And she messaged me back and was like, nah, man, absolutely not. And I was like, that's interesting. And I was talking to her and I was like, how are you finding? She's like, I love it down here. There's so much going on, and she was like, we can buy a house for like 650 grand in a really good location. They're like selling their stuff in Auckland, their property in Auckland to move down there. And I was like, that speaks volumes. And like, I'm not surprised by this Canterbury hitting that price at all.
Yeah, I think that would likely be reflected, that sort of concept, in domestic net migration. I would also suspect that not many people are moving to Wellington who already live in Auckland or Christchurch.
Everyone from Welly's moving to bloody Christchurch.
100%, yeah. And the thing about your suspicion that Christchurch will outperform Auckland, I think is obviously quite correlated with the DTI side of things, where Auckland was really stretched at DTI and crashed really hard, but Christchurch's DTI wasn't stretched anywhere near as much. And remained quite buoyant through the crash.
For anyone who doesn't know what DTI is, it's debt to income ratio, which is another kind of like handbrake that the Reserve Bank put on, or another limit that the Reserve Bank put on banks for lending. So, I can't lend more than 5 times or 6 times or 7 times my income on debt. It's just kind of a way of like smoothing out those kind of extreme highs and extreme lows of the housing market, and then trying to make sure that people's incomes are aligned to house prices and not so divorced as like they were in kind of 2021.
Yeah, for sure.
Yeah, pain in the ass is what it is. Yeah.
And then lastly, one really important thing, obviously we talk about clients getting caught up in the headlines all the time, and not to focus all of your education based on what the latest news article says. Median sale prices often skew market perception because if a lower price point in the market is transacting more, then it's going to skew median prices to fall lower. So the way to get around that is Ryan's have something called a HPI, which is a house price index, which is essentially comparing apples and apples rather than apples and oranges, which you can do if there's a difference in market transactions at each segment. Long story short, Auckland is up 1.33% in the last 12 months, and Christchurch is up 2.9%.
Christchurch, baby. I'm telling you, that's the city of the future.
Yeah, a lot of our investors are focusing down there for that reason.
Yeah, even on the commercial side, a lot of our investors are focusing down there as well. I think it's really important to point out here, as two property nerds, just having a chat. We're not trying to grasp at straws. What we're not doing here is going like, buy. It's all going to be great. We get asked about this a lot in terms of like, what are the things you guys look at when you're making your decisions or giving advice to customers? So really what we're trying to do here is go, hey, here's some data points that everyone can look at and just think like, okay, can I pick up trends in the market, or can I see what's going on here? Or if I see something and I go, I wonder what this means, should I speak to an expert about it?
100%, Mike. Completely agree with everything. Couldn't have said it better myself.
Nice. All right, we'll wrap this up here. Make sure you rate, review, subscribe, and we'll catch you next time.
Thank you kindly.